the privilege of being an essential business. And however, I know it's busy for you and things have changed for me in what is essential, but we're providing needs. We're providing services that help people get into housing. And so I was hoping that you would just take us through, like, tell everybody who you are, what you do, and then I have a bunch of questions for you, if that's okay.
Perfect.
Okay.
I'm Jim Willis, and I'm the branch manager at Primary Residential Mortgage here in Vancouver, Washington. Been in this business for going on 20 years now. So seen the highs and the lows, but this is something that's completely different than anything we've seen, in the past. So, but, in the end, I think, as long as we all keep working at it, we'll all get through this. So.
Absolutely. And by the way, I find I touch my face. The more I see myself on camera, I touch my face all the time and I have to stop. Oh my God. Details, right?
Exactly.
So burning question for you, the kind of the big one, the state of Washington talks about 17,000 residential transactions going through the process. And I know you don't handle the 17,000 loans for the state of Washington, but what are you seeing? How many of these loans that are in process are closing right now? And what are the challenges of closing? Or on the flip side, what's the good news and the high percentage that's actually closing?
Well, I mean, so far, knock on wood, we haven't had any that haven't closed due to, people being laid off and things like that. So, I mean, your question it's a little bit difficult because every situation is a little bit different. And the people that really are affected by this the most are going to be your service industry people and your travel industry, because, they're in front of people all the time. So they're not able to actually go to work. And so instead of, laying them, a lot of these companies are laying them off so that people can get unemployment. That's the difficult part because, we don't know who has been and who hasn't been laid off, or if they're reduced schedules or, things along those lines. So we've had to go back and basically call every one of our clients and just make sure that they're in a situation to still close their home loans.
Wow. So is that employment verification, or is it a little subjective? Hey, is this a good thing for you to be doing right now?
So the reason that we're doing it just so that we don't get caught at the end, because it used to be that they would do verification of employments 7 days from closing. Okay. Now they're requiring that we do them 3 days from the note date on the note. So that's pretty close to your closing. And they also have added a kind of some verbiage in regards to when they did a verbal verification of employment, they would just ask if they're still employed there. Mm-hmm. So now what they're doing is they're asking that, how was that worded? So when the processor calls to do it, she has to ask the employer, is the borrower's income expected to continue into the future at the same or similar level?
Oh, that's an interesting question.
So that's the tough one, because now they can't just say, are they employed? Because yes, they might be employed, but they may not be working at this time. Mm-hmm. They still may be employees. So I think that's going to be one that's going to bite people. That's the one that's going to, that could, change, whether they're able to continue with the refinance or not, or even a purchase.
Right.
But, everybody knows that, the purchases have slowed down a little bit because the refinances have picked up, and people not, agents not be able to go out and show houses and things like that until just lately.
Right. And so, and there's a change for all of us, but I still find in my business that I have a family that just recently relocated and we're listing their home. I just bought a Ricoh 3D camera because I can't have a photographer in, but I can go take pictures. So the tech side of me has had to adjust a little bit for sure. And we've certainly gone to Zoom meetings and live Facebook tours, and we're still here to help. It's part of being essential. So those were my first two questions for you. And so any change in prerequisites or precautions for anybody who's looking to get a loan today?
The biggest one has been government lending, your FHA, VA, and USDA. There's really not an appetite for people to buy those at this point, and also the risk is somewhat high on them, is what they're saying. So instead of, before, like on an FHA loan, we could go down to a 580 credit score. Well, they've now changed, most lenders have changed it to a 680, which is actually pretty high for FHA. That's FHA and VA, and USDA, all your government products. Mostly VA and FHA, because at that point you weren't usually getting the USDA approval anyways. They're a little bit more strict on their credit guidelines. But yeah, 680. Some companies are doing 660, but they're also requiring maybe 3 months of reserves.
Okay.
Instead of just, before, even with a 580, you could do it without reserves. So
is there anything that you can translate the difference between a 580 credit score and a 680 credit score for someone like me to understand?
Typically, I mean, I would say that it has a lot to do with just their past credit history. 580 was as low as we would go. I know there's companies out there that would go lower because FHA doesn't really say that you have a certain point that you can, lend at. But for us, we were 580 or higher. A lot of companies are 600 or 620. It's just risk. I mean, the risk of it.
Does that mean somebody like has a car loan that they've paid all the time, or is it a debt to ratio? And I mean, what's the magic behind the credit score?
A lot of it has to do with if you've made your payments on time. If you have late payments, if you have, foreclosures, bankruptcies in the past, collections, public records. Also, if your credit cards are maxed out, if you don't have a lot of revolving capacity on your credit cards, then your score is definitely going to be affected by that. I mean, when you look at it, when people classify credit scores, they're saying, anything from like 580 to 600, 620 is is poor.
Welcome to working from home.
Yeah, exactly. And then, you get above a 740 and then it's excellent. So, it's the majority of the people that you work with FHA were a lot of times in that 620, 640 range. Okay. Where now it's difficult because they can't get a loan at this point unless they go conventional, which they have to have a little bit more as down payment, and then also their mortgage insurance is going to be higher, and the rate's going to be quite a bit higher for that lower credit score.
So lending is still possible. It's just tighter, and like this is a really good time for people who maybe didn't have their house keeping done in their financial world to maybe get it together now.
Right, absolutely. Yeah, okay. I mean, they may not be able to buy right now, but I mean, there's a lot of things that we can do on our side to coach them, to let them know, here's what you need to do in the next, 3 months or so to get your credit to, a point where you can purchase. But at that point, I have a feeling that they're going to open these back up anyways. Once this stuff kind of settles out, kind of the dust settles, that they're going to go back to, where we were before. It's just a matter of time. And at some point, when people are willing to purchase these loans, and that's a lot of it right now, is that even Fannie Mae and Freddie Mac, and then the people that we're selling these loans to, the servicers, they just want the best of the best. And they also said they have so much that they don't want all of these loans. And so they're not really buying them.
Right. And did I read somewhere that as the federal government changes their rates, there's really not an incentive for the purchasers of these FHA loans to buy them? Because especially
especially with the FHA and those loans, because they're typically a little bit higher risk. So, but I mean, what we found out is we're starting to have to service a lot more of our loans. We used to do about 20% of our loans that we serviced. Well, right now, if you're going to sell to one of these wholesale lenders, these wholesalers, they're not going to give you a very good price for the loan. So you're going to be selling them for basically nothing until all of this kind of shakes out. Right.
So right now it's a process of maybe getting through what you have on your plate, which was big because as the federal government started reducing rates, people started refinancing in addition to purchasing homes, right? Like we knew we had purchase momentum, but can you explain, and this might be a big one and a long one, but can you explain what happens when the federal government reduces their rates and what happens to the rates in lending? Because we've seen them up and we've seen them down and all over the place.
So right now, what the government decided to do with the stimulus package is to pump a whole bunch of money into the mortgage-backed securities and the 10-year yield. So those are things that typically bring down mortgage rates, and that's what their intention was. But the problem is that they're actually, by buying all the mortgage-backed securities, other people jumped on and did the same thing. Well, that just brought everything down. And so there's margin calls for these companies that they can't pay. And so that's why a lot of companies are having to sell some of their servicing for pennies on the dollar just to make enough money to pay their investors, basically their wholesale lines, the amount that they're owed. Because when you lock a loan, you're locking at a certain rate, okay? And if that you don't pull through, you still pay the difference, basically, if those locks are broken. And so those are your margin calls. So you just have to make sure that, and that's what they're trying to do right now, is they're trying to actually bring rates back up. Because today or yesterday, instead of buying $40 million in or $40 billion in mortgage-backed securities, they only bought 21. So,
wow.
Which is good, because what that's done is actually, instead of, the mortgage-backed securities just, going up and up and up, it's actually brought them back down, which should increase rates a little bit. They're just trying to get all of these loans closed so that you don't have all this fallout, and these companies aren't having to pay these margins, which they really need to do to get all as many of these, refinances and things off the books, so that they, in 3 months, because I mean, most people will have, probably did 45 or 60-day locks on a lot of these refinances. You get to that 45 or 60-day period, a lot of these are going to be off the books. And it's also going to open up a lot of the operational stuff, especially for us, like processing, underwriting, that, when you have a processor that's got 70 files, I mean, that's just too many. And, but we don't have anybody, it's not like you're going to go out and hire somebody right now, because
you'd still have to train them, and there'd still be a learning curve.
Well, yeah, and anybody that's good at this job is already employed. It's not something that's really, easy to pick up on and things like that. There's a lot to it.
And a lot of things that go into it too.
Yeah, I think a lot of it has to do with, I mean, the reason that these rates, I mean, our rates could be lower, I'm sure, but I know that they're holding them at a certain level just for capacity to try to slow things down a little bit. And a lot of companies, what they're doing is they're actually pricing their refinances higher than they are their purchases.
Isn't that typical though?
No, ours aren't. We're not pricing you differently.
Okay.
Our refinances are the same. The difference is sometimes refinances are higher just because of some of the factors that go into it, especially if they want cash out, or if their loan to value is a little bit higher, things along those lines. Sometimes your rates can be a little bit higher than your purchases just because of that.
Got it.
But it's just a matter of everybody getting caught up. That's a lot of it.
And it's interesting. Yeah, we would love to see you guys caught up. I mean, I know for a while you just recently did a loan for me that was like 20 days from start to finish, and now I'm hearing 45 to 60 days on certain processes. So it would be nice to see you guys catch up. I'm sure you guys would like to breathe a little bit too.
Yeah.
What questions are you being asked on an everyday basis right now when your customers are calling in? Is there anything that we've missed right now?
I think the biggest thing is the misconception between the Fed rate and the mortgage rates, because I probably got 40 or 50 text messages the day that they dropped the Fed rate to 0.25. And so basically everybody thought that that's what the mortgage rates are going to be. Rates are going to be zero. I know. And we
all go by houses.
Yeah, exactly. But it's one of those things you just have to educate, make sure they know that that's a short-term rate. That's not your long-term mortgage. That's what the banks are basically, buying and lending the money between banks at an institution. So it is cheaper for them to get money at this point, but that doesn't mean that you're and those are short-term rates, whereas your mortgage rates are, long-term. It does affect it. It affects the amount that people are buying with mortgage-backed securities and things like that, which it did bring rates down, but they're not a direct correlation. And the conversation I had with the client when he's like, well, they're at 0.25%, is that where rates should be? I said, well, last month they were at 1.75%. Were you getting loans at 1.75%?
Good question.
And they said, well, no. I said, well, it's not a direct correlation between the two. So it's just making sure that people are educated and they know that yes, rates are going to go down. And I think here's what what I've been kind of told, and from the people that are a lot smarter than I am, is that at this point right now, they're just trying to make sure that people don't lose all of these locked loans and things like that.
Yes.
Because it's going to cost the mortgage companies a lot of money. And so they're just trying to make sure that, people aren't, I mean, especially on our side, we're not trying, especially early payoffs. That's a tough one. Somebody that bought, say, 3 months ago that wants to refinance. Well, if they refinance, basically that, if they refinance with another company or even with your company without making 6 payments, then the mortgage company gets hit with an early payoff from the investor because they paid a certain amount of money for these loans. And if they're not going to make any of that money, they're going to ask for that money back.
Yes.
And those are super expensive. And that's the cost of doing business. It's really expensive for the mortgage companies that people don't see.
So if this were my social media status, it would be, it's complicated.
It is. There's a lot to it. And there's a lot on the backside that your consumer doesn't see. I mean, of course, they want the best rate possible. So if they see a rate that's a point higher or lower than what they just purchased for 3 months ago, then it might make sense for them.
Mm-hmm.
But, from the person who did their loan, it's always nice to educate them and let them know that, it's up to them. They have the ability to do it. Nobody's going to stop them from refinancing, 3 months in, but it's just going to take a toll on the mortgage companies.
And it's interesting that you do have to educate people, because I wouldn't have known that. And I've, bought and sold several homes and didn't realize that you had to have 6 payments in. Would you consider doing a first-time buyer's education with me?
Yeah.
I'm putting you on the spot right now, and do it in the same format so we could ask questions and get some of the common myths answered. Okay.
Yeah, for sure.
And what would you say to both consumers and real estate agents right now? What would you want us to know? What can we do to help you and to help keep everything in process and moving forward?
I would say education, because I mean, you guys you're the front line. Basically, you're the ones who have these these customers a lot of times before we do, just to make sure that they're not going out and looking for homes that they're not employed, things along those lines, and make sure that they are pre-approved before they go out.
Well, and that's one of the things that we have to do now. And the mandate didn't come out and say clearly that, but it does say that we have really strict protocols to follow. And while we're allowed to show a house with 2 people max, meaning, if the house is vacant, then I sit in my car and they can go in, or I take one person in the party in and then I come back out and we swap out. But the question needs to be, in keeping us all safe, are you pre-approved?
Right.
Is this a need that you have? Because we all want to be respectful and cautious and not abuse the privilege of being essential.
Yeah, absolutely. I mean, because that'll just shut it off for everybody if people take advantage of that. So,
that's right.
I think going back to what you were talking about earlier with the close times, we're still on our purchases. We're still 30 days or less, because we put those ahead of those come way before refinances, because we lock them on a longer, typically our refinances we lock on 60 days.
Oh.
So it gives us more time. I mean, we're mandated right now to lock all of our refinances on 60 days.
Okay.
To give everybody enough time, because we don't want for one thing, we don't want their lock to expire.
No.
We won't let it expire, but it gets, if it's something that's not, if they've done everything on their side, there's no reason for them to have to pay for lock extensions if it's a company that's slowing things up,
Right.
So we want to make sure that doesn't happen. But the problem is that it's not really about us as much. It's the third party vendors that are the ones that are slower right now. Your appraisals. We're getting a lot more appraisal waivers now, even on our purchases and refinances.
Do with a conventional loan, but not any other loan?
No, you can. Yes, exactly.
Okay.
Yep, you can't get it on any of your government loans, but Fannie Mae and Freddie Mac, you can run through their system and see if you get an appraisal waiver, like we did on the one that we did.
Right.
So that really helps out. Because most appraisers, or a lot of appraisers, aren't willing to go into homes right now. They won't appraise them.
Right.
So they're turning down our orders. And so what they've done is they've actually opened up, it's kind of a smaller niche, but they're allowing for some drive-by appraisals.
I read that.
And they're also talking about, so they're using the photos, especially on purchase, they're using the photos from the RMLS and things along those lines for their interior stuff.
Which right now is pressure on us as real estate agents, because we can't have a photographer come in. But to do our sellers justice, we have to learn how to take good pictures.
Yeah.
And write really clear notes in the remarks that we have 500 characters to do that with.
Right.
So I mean that's our social responsibility right now. I think I'm encouraged to see that appraisers some of them are still working. I'm encouraged to see that there's flexibility in mobile notary, not only to mobile notary but to e-notary now, as well as our inspectors are considered essential again. So again, all with precautions. Our state attorney definitely sent out a video that said, do not abuse this privilege.
Right. So what are you seeing from inspections? I mean, are the inspectors still willing to go into these homes, especially if they're occupied?
So my listings happen to all be vacant right now. And so I think that is a benefit to having a vacant.
Sure.
I have 3. I have one that's in transaction right now, and I have 3 that are coming up to list, all vacant. So it's not a challenge that I've had to work through right now, but I know they're all taking precautions, and I know that they are wearing gloves, and I know that they are sanitizing the best that they can and keeping as much distance as they can. So, and I actually have a meeting with Pillar to Post later this week, which is our inspection company that we use the most, to kind of ask those questions about what they're doing to keep individuals safe.
Okay. Going back to a couple things. So you were asking earlier about some of the things that maybe companies aren't doing and things along those lines. I've seen there's quite a few of the banks that aren't doing cash out refinances right now. So they'll do refinances, but they've jacked their rates up a bit. So if you go into Wells Fargo, you'll see that their purchase rate is like 3.25%, 3.375, something like that. But their refinances are almost 4%. So they're kind of
mitigating risk right now.
That, and I think that they're just it's kind of the low hanging fruit. They're trying to get the stuff that's paying a little bit more so that their margins are better on them.
Sure.
And so if people are willing to do it, then they're doing it. I did have one of my clients that is working with IQ right now, and they just told him on just a rate and term refinance that it was going to be 4 to 5 months.
Holy cow.
Yep. I just got that text today. I'm like, okay.
I
that's a lot.
can do that in 45 to 60.
Yeah, exactly.
Yeah.
I mean, 4 to 5 is ridiculous. You don't know what's going to happen at that point. And that's the hard part, is because a lot of those people, especially if rates go down, they're going to pull those locks and go somewhere else.
Yes.
If they can get them done in better time.
Right. And I think, again, it goes back to why we are considered essential, because people still need housing. And I think that those people who are not having an immediate need are probably staying home. I haven't seen a whole lot of shift. We've seen some shift in the way we service. I'm sure I can only speak for today, as can you, but 3 to 6 months does seem like a very long time.
It does. A lot of things can happen between now and then, in terms of maybe even, losing jobs, if this thing does continue for longer. The other thing that we're seeing, though, is like your non-QM lenders, which are, that they don't sell to Fannie and Freddie. They're more your non-warrantable condos and things like that. They've kind of pulled back completely, and they're not really, for us, we don't have anybody that we can do any non-QM stuff with right now.
What does QM stand for?
You have to put me on the spot. Quality mortgage. So okay. Qualified mortgage. So qualified basically means that it is within the standards of Fannie, Freddie, Ginnie Mae, which are your FHA, VA. These are things these are outside the box. They're private. They're more like portfolio things. Exactly. Private money.
Okay, and that's a lot of what we saw back in 2005-ish, was a lot of private lenders coming in the market.
Yeah.
And that was what caused some of the trouble. So they're stepping back now, which is probably a good thing.
It probably is, because they've come out with some of these, no income doc things again, which we don't do any of those on our myself. I'd rather not. There's plenty of other business besides stuff that in my mind can get people in trouble. So
Yes, and I think that's a great segue into why you pick your lenders carefully. And it's part of a conversation that you and I had kind of when we first got started. And it's something that I've admired in working with you is that, so people have said to me, Susie, you'll always know where you stand when you work with Susie. And I think the same thing stands true for you, that from a lending standpoint, you'll always know where you stand because there's no sugarcoating. The numbers are the numbers. What we can do is what we can do from your standpoint, and you're very truthful and honest. So
that's the biggest thing is the honesty, and make sure that people know, give them the hard answers to start out with, and let them know, let them know where they're at to start out with, and let them make the decision if that's where they want to continue to go.
Yes.
So
and I have to ask some of those hard questions too, because I think it makes a difference. So if anybody's watching and wants to get a hold of you, what's the best way to reach out to you?
Either by phone, 360-608-8872, or email jim.willis, WILLIS, @primeres.com. So that's PRIMERES.com.
Awesome. Well, I so appreciate your time. I know it's changing every day. We could probably do this again next week.
Yeah, it'll change, I'm sure.
Absolutely. So thanks for taking the time with me, and I hope to see you soon. I hope in the meantime, lots of hand washing.
Yes.
And love that family of yours and enjoy the time home with them.
Thank you. Thanks, Susie. Have
a
great day.
You too.
Right.
Bye.
Bye-bye.